Let's start off by telling you who our guests will be joining in today on the show. But we'll get in Mahesh Patil, co-CIO at Birla Sun Life Mutual Fund, Anand Tandon, CEO at JRG Securities, and Sandeep Wagle will be joining in on the charts. And I'm going to start off with you. Is it going to be the core fundamentals of the Indian economy in terms of the domestic macroeconomic factors that will really take precedence and drive our markets either upwards or down? Anand?
Oh, sorry, I didn't think that was for me. Well, yeah, like Nikun says, I think the time for the easy money is over. I think we're trading at the higher end of the range. If you look at most of the companies which are performing, take TCS for example, again, very decent set of numbers. But the question is, it's also probably one of the most expensive stocks in the market, it's close to $70 billion or thereabouts. It is not really something which is very cheap, 22 times 15 earnings. So the companies that are doing well are already probably priced to perfection, if not more. Those which are doing badly are not showing any signs of life even now. So I think it is now time to relook at where you're going to be putting money in, because it's not as if there is the performing set is very small, and that's not likely to be becoming cheap anytime soon. Until and unless you have a real upturn in the fundamentals of the economy or the company, it is unlikely that the cheaper stocks can go up. So I think you'll have to get more and more stock specific at this stage, and perhaps even hold your fire for some time, waiting for a proper correction to happen.
Right, Sandeep. Tuesday's price actional was rather non-inspirational. We started the day with some promise, but in the second half of trade, things completely reversed. The fact that Nifty once again has scaled to go past 6150, is that non-inspirational? Is that a dangerous or a red signal for the bull?
Good afternoon, Nikunji. I would not say it is non-inspirational, but yes, some certain profit booking is what is for sure. So we cannot rule that out, and importantly, at a level where it has happened in the past, does suggest that at this level it is not going to cross this time also with ease. Having said that, I don't want to be that bearish where I will talk of a 10-12% movement on the downside. I would still talk of a range of a 5900, 5950 on the downside, which will act as a support. And on the upside, again, we move in that 6150 band. So 5950, 6150, that 200-250 point band is what we will witness for the next few days or weeks to come in. I would still be a buyer at lower levels, and we have been talking of a caution at these levels. Now, in fact, it has gone above 6150 and failed to do that. I don't read it as a weakness or a sign of weakness where it should crash down one way and it will go down by 15-20%, as I said earlier. I would buy in the range of 5950, 5960, somewhere around that, with a stop loss of 100 points on the Nifty, and I would still say that 6150 will be again in sight, and more of stock specific moves is what I expect. And this time the banking space has given way, so banking I expect some more downside.
Okay, that's a call coming in on the broader markets, but the stock which will be on everyone's radar will be TCS, a dazzling set of numbers. You had the profits which were up by close to 24% on the back of a good order inflow, as well as the weakness in the currency that we've seen. The management also is fairly confident that the deal pipeline is robust across all the verticals, and you did have the volume growth which certainly outdid itself, coming in at something like 7.3% for the quarter. Mahesh, let's talk about the overall action in the IT basket. In the near term, the fundamentals, as we've seen for TCS, very supportive. But somewhere do you think that the prices are now looking slightly stretched? Large cap IT stocks are now approaching a bubble territory?
Well, we have seen that whichever sectors there have been good amount of earnings visibility and stability, market is willing to pay a premium for that, especially in an environment where the domestic outlook is pretty weak. So we have seen that initially in the FMCG sector, then in the pharma sector. In IT sector also, we have seen greater visibility in terms of volume growth, especially in the US market. We have seen some uptick in discretionary spending, and that's reflected in terms of the volume growth, what we are seeing in these quarterly numbers. And to some extent, tailwind coming in from rupee depreciation. Though I think recently rupee has appreciated, but I think if you look at any forecast from a medium to long term, people expect rupee to depreciate by around 4 to 5% annually. So I think all these factors gives better higher growth rate for these companies. So earlier you were looking at around 12-13% kind of a growth, revenue growth. Now we're looking at more than 15-16% kind of a top line growth. and with some margin improvement, our bottom line growth can be around 20%. So I think PE multiples are also expanding in line with the kind of greater earnings visibility and higher growth what we are seeing in the foreseeable future for the IT names. So I think very difficult to say what's the bubble territory, but as long as we continue to expect strong numbers, I think the multiples will sustain at these levels.
Anand, wanted to know your response to the HDFC Bank numbers, because you did have the performance which was fairly stable. You had the asset quality which was also maintained, but it seems like HDFC Bank is really getting exhausted at these levels, not seeing too much of an up move.
Well, yes, I mean, it hasn't been as sterling a performance as one has got used to from HDFC Bank. And but you have to keep it in context that the rest of the sector is under serious stress. And it appears to that even in the pipeline of restructured assets that are still likely to come in for restructuring, it would appear that that HDFC Bank has really sidestepped most of the possible potholes that have since arisen. So it's still an extremely good performance, but it is a company which is probably the most expensive in terms of valuation at that size. So it would be looking a little stretched at a time when the banking sector itself is not doing particularly well.
Mahesh, jump in on banks. What is your take there? Banks are no longer oversold. In fact, PSU and private banks have made a sizable comeback. The new governor is committed to kickstart banking reforms. He's now talking about M&A in the entire banking space. In general, is it time now to be a contra buyer in banks?
Yeah, I think the banking sector clearly is a play on the economy, underlying economy. We have seen economy not really recovering. In fact, it's deteriorated further looking at the IIP numbers. And even this quarter GDP number would also be pretty subdued. Given the fact that interest rates are also not really likely to come off significantly, I think the stress on the asset quality will continue. And we have seen the number of cases which are being referred to the CDR cell have been increasing. And that's a reflection of what to expect in the next few quarters on the asset quality side, especially on the corporate borrowing and also the mid and the small enterprises. So and that's something which would be a bigger factor, especially when you're looking at the banking stocks, because any increase in the asset quality on the stressed assets would have a significant impact on the book value and in terms of valuations. So I think that's going to be the overriding factor, especially for the PSU banking space in the next few quarters.
Sandeep, another result candidate, Bajaj Auto, how would you be approaching it on the charts?
Well, Aman, Bajaj Auto has given a very clear breakout at a level of around 2040, 2050. So any move towards that, I am very comfortable buying, and probably a good stop loss can be probably 30-40 points lower, a little below 2000. And I would very clearly look at levels of 2250, 2300. Now, this is not a view for the next few days, but I would talk of the next 3 to 6 weeks. And I have a target of 2250, 2280, and that can probably extend to 2300 as well.
Anand, the other important highlight feature for the month of October has been big, powerful rally in cyclicals, autos, banks and real estate. Now, cyclical is the weak part of the market. Despite the inherent weakness, what explains such a powerful comeback in cyclicals and especially autos?
Well, I guess the trigger could be the announcement that the minister made saying that they will be looking to finance consumer durables and consumer discretionary essentially through banks by increasing equity. A very strange announcement to make, because you are getting to a stage where you're talking about directed lending all over again. And I think the governor subsequently did kind of tone that down a bit. But I think that may have been the trigger. But the other reason could be simply that this is usually a season where the consumer durables etc. will do quite well because it's the seasonal high. It's the festive season beginning, and if you do find that there is some ease in terms of availability of credit for this sector, then clearly it was a sector which was somewhat oversold. Whether it will continue from here, however, is a different question, because I think, as you mentioned, it is not yet the season for cyclicals. We are not yet seeing any signs that interest rates are actually beginning to taper off anytime soon. And, so once the oversold bounce is over, I think you'll get back to looking at where the valuations are, and it won't look very attractive at that stage.
Mahesh, how would you explain the inherent strength that we've seen in select cap good counters? Because when it comes to the macroeconomic data such as the IIP number, the fundamentals continue to remain weak, yet these stocks have rallied.
Well, I think there could be one view which the market is taking, or some investors are taking is that, yeah, we are at the bottom of the cycle at this point in time, so everything is looking bad. And if at all, if you take a slightly longer term view, when I say longer term, 1 or 2 year view, then as we move out from this cycle and as we near elections, I think there is a hope which is emerging that the next capex cycle will start somewhere in the middle of next calendar year post elections. And a lot of these stocks are now quoting at very, very low valuations compared to the long-term averages. And typically, and we've seen some kind of a sector rotation also happening more recently. Some of the sectors, cyclical sectors especially, where the valuations are beaten down. And some likelihood of recovery in the medium term, we are seeing some interest coming in there. So I think it's slightly early days, as you said rightly. We are not seeing any fundamental pickup in terms of order inflow, and will take some time. But someone with a longer term view, if you take a longer term view, this is a good time to start accumulating the stocks, because when things turn, we see a sharp operating leverage coming into play, and that leads to a bigger upside. So I think it's more of kind of a contra buying in these stocks at these levels is what's kind of driving the prices at this point in time.
What should traders monitor for tomorrow morning? For that, let's go to Sandeep. Sandeep, what are your top ideas for tomorrow morning apart from Bajaj Auto?
Nikunj, I am finding strength in the metal space. In case the Nifty were to correct a bit, I would use that correction as an opportunity to buy. I have a buy in a Tata Steel, stop loss of 308, target of 322. As I said earlier, the banking space is looking weak, so I would sell a Yes Bank, stop loss of 343, target of 320.
Anand, just wanted to get in your opinion when it comes to the defensives, because you do have quite a bit of volatility in terms of earnings expectations. How would you be placing some of the large cap FMCG stocks vis-a-vis the mid cap contenders?
I think the FMCG space has, pretty much run ahead of itself now, especially companies like Levers. You could make some small argument for continuing to look at an ITC, though it has been one of the best performing stocks, and is also beginning to look a little stretched, but possibly you can still hold on to it. But companies like Levers, for example, has pretty much run its course, and I think the hope that buyback kind of allowed will probably also fade out, once the company, unless the Unilever comes back and starts to buy again. So unless you are very, very of the view that inflation will continue to remain very high, especially consumer inflation will remain very high, there is no particular reason why you should be holding on. Smaller ones, you have to look on a case. There may be some value there.
Mahesh, let's revisit auto, and I know you have a large holding in Hero MotoCorp and Tata Motors. As a fund manager, are you still tempted to buy auto stocks, or the margin of safety is now missing and you would wait for better entry point as the year unwinds to re-enter auto stocks?
Yeah, in the auto space, again, this is a sector which has suffered in the last 1 year. We have seen a dramatic slowdown in terms of auto volume growth. Especially discretionary spending has got impacted. But I think, again, this is a sector where we have seen a lot of the companies, the frontline names, able to really manage their margins, especially in a weak environment, pretty well. So while volumes have been weak, margins have been pretty stable. And as we move forward, we have seen almost 1.5 years of kind of slow volume growth. Historically, we have seen that whenever there has been a period of lull, long period, when I say around 1 or 2 years, I think the year after that we see a sharp jump in volumes. So I think again there is a hope here that next year after 2 years of down cycle, one could see a recovery, and mind you, interest rates would also view is that longer term interest rates will ease off. So I think given the combination of these factors and the fact that the companies are still holding on margins, I think when the recovery happens, there could be a sharp surprise on the earnings side. And a lot of these companies are still generating pretty good return on capital employed, free cash flows, and the valuations are not that demanding if you compare to the broader market. So I think all these factors are leading to some kind of re-rating in the stocks, and some of the other companies like Tata Motors are also doing well on the export side and JLR. So I think rupee depreciation is also helping some of the companies to boost their exports and add incrementally to the volume growth. So we are neutral to positive on the sector, auto space, and we believe that auto angst also offered a good opportunity really to ride on this opportunity.
Sandeep, let's talk about mid-cap consumer names, and mid-cap consumer names also have made a roaring comeback. You got Bata, price action in Zydus has started. In general, are you constructive there?
Nikunj, absolutely. In spite of the fact that it did correct yesterday, I still feel the pattern is good enough to be bought at lower levels. In fact, at this level also I'm willing to buy Bata at a level of 880. And I would talk of a very clear, at least a 10 to 12% trading upside over the next few days or weeks. So yes, I am very positive and don't see too much of a downside. 3-4% correction should be used to buy.
Right, Sandeep, Mahesh, Anand Tandon, gentlemen, really appreciate your time and thank you for joining us.